Let's say you want to invest and you have seen all the amazing headlines regarding numbers go up indefinitely and you get annually around 7% returns. You start to look into the most commonly mentioned indices on Reddit and think, this is it, you're going to be on top of the world. You open a brokerage account and you start to invest. But after a couple of months, you potentially realize that the returns are not the same as you thought they would be. For a non-US investor, there are two things you must bear in mind when you start to invest, namely inflation and currency risk. Let me show you what I mean. To illustrate this, I will first show you the nominal returns of several common indices. Then we'll take a look at the hypothetical ideal world where inflation is steady at 2%. However, since we do not live in an ideal world, we will then examine these returns adjusted for actual inflation. Lastly, I will shed some light on the impact of currency risk. These are the indices I want to compare. It's important to mention that these are not any specific ETFs, but their underlying indices. Because as soon as you move to ETFs, you have to consider costs, whether choosing the accumulating versus distributing version, which provider, etc, etc, etc. Let's begin with the S&P 500, a broad stock market index that tracks the performance of the 500 largest publicly traded companies in the United States, serving as a primary barometer for the US economy. Then the Nasdaq 100. An index comprised of the 100 largest and most actively traded non-financial companies listed on the Nasdaq stock market, with a very heavy focus on technology and growth. The MSCI World, a broad global index that tracks approximately 1,500 large and mid-cap companies across 23 developed market countries, covering roughly 85% of the free float adjusted market capitalization in each. The Stoxx 600 Europe, a pan-Europe index that represents 600 large, mid and small capitalization companies across 17 European countries, covering approximately 90% of the region's free float market value. The SMI, a serious mental illness that lives in every penny stock trader. Just kidding. It stands for Swiss Market Index and is Switzerland's blue chip index, which includes the 20th largest and most liquid stocks traded on the Swiss stock exchange, representing about 80% of the total Swiss market. Since gold has been on a tear lately, let's take a look at it as well. And as a bonus at the very end, I will also take a look at Bitcoin. Let's jump right in. Let's first take a look at the cumulative returns over the last 10 years. Let's assume you invested 100 currency units at the beginning of 2016. This is what it looks like now. As we all know, the tech and AI boom in the US has lifted those indices heavily. Therefore, we find the Nasdaq 100 and the S&P 500 on top when it comes to the equities. The geopolitical uncertainties lifted gold to a new all-time high. And since around 65% of the MSCI World has an exposure in the US, it is placed right in the middle and was also lifted by it quite heavily. And at the very bottom we can see the returns of the SMI and the Eurostoxx 600. Not that many groundbreaking things have happened in these markets, and innovation is too quickly regulated, and therefore we only get around 50 to 40% returns over the last 10 years. Let's quickly memorize the values on the y-axis, because compared to the ideal world, which we will take a look in a second regarding the 2% inflation, the curves don't change anymore. It's just basically the y-axis that is going to change. So we see if you invested 100 currency units 10 years ago, you would have gotten now around 550 currency units when you invested in the Nasdaq 100. Around 400 in gold, around 370 in S&P 500, etc, etc. So just memorize these values, and later on we will see what happens with the imaginary world and the real world and the currency adjusted world. At the very end, obviously, I will show you all the numbers side by side. Let's move on from this imaginary world to the ideal world, where we have 2% inflation, which is basically the goal of most national banks around the world. As mentioned before, only the y-axis changes, but already with this view we can see the drag of inflation. The Nasdaq 100 is dragged down from 550 to 450, gold from 400 to 350, and etc. But let's not spend too much time with fairies and other strange creatures in this ideal world, and let's move on to the real world and take the real inflation rates for the US dollar, euro, and the Swiss franc. Let's go. Let me first explain to you what I mean by real inflation data. This chart displays the cumulative inflation in the United States, the Eurozone, and Switzerland over the last 10 years, with all indices normalized to a base of 100 at the start of the period. Unlike a standard annual percentage change chart, this visualization shows the total increase in the cost of living over time. A value of 120, for example, indicates that prices have risen by 20% since the start date, meaning 100 francs or dollars today can only buy what 80 did back then. You will notice a significant gap opening after 2021, marking the global inflationary spike. Notably, the Swiss, the HICP, remains the lowest line, illustrating Switzerland's relative price stability compared to the steeper upward trajectories of the US and the Eurozone. This visual sets the stage for our real return analysis. It represents the hurdle rate that an investment must overcome just to remain its original value. Since the S&P 500, the Nasdaq, the MSCI World, and gold are all denominated in US dollar, these lines do not change with respect to each other, and for them only the values on the y-axis change. However, they change compared to the Euro Stoxx 600 and the SMI obviously. But we now can also see some changes with the SMI and the Euro Stoxx. The euro had a much more severe inflation rate compared to the Swiss franc, and thus the index fell below the SMI. If you are from the US and you invested into US nominated indices, this is relevant information for you. But if you are not living in a country that uses the US dollar, it might make sense to take a look at the next step. Again, let me first show you what I mean by currency risk. This chart illustrates the relative strength of the Swiss franc against the US dollar and the euro over the last 10 years. By normalizing the exchange rate to a base of 100, or 1 in this case, we can clearly see the currency headwind or tailwind facing a Swiss investor. A line trending below 100, or again 1 in this case, indicates that the foreign currency has depreciated against the franc. For instance, if the US dollar against the Swiss franc line sits at 90, it means the dollar has lost 10% of its value relative to the franc since the start of our analysis. For a Swiss investor holding American stocks, this downward slope represents a hidden reduction in returns. Even if the stock price remains flat in New York, the investment loses value in Switzerland because each dollar earned now buys fewer Swiss francs. This visual highlights why global diversification requires not just picking the right stocks, but also managing the impact of a historically strong Swiss currency. And here we see the result on our indices. Obviously, like all the US dollar nominated indices are being dragged down even more and come closer to the SMI. The SMI itself remains the same, obviously, like 1 Swiss franc back then was not 1 Swiss franc right now. But what is crazy is like the euro, it fell even more. And now, like as you can see, like 10 years ago invested into the Euro Stoxx 600, compared to today, you're basically at the same level. This is just crazy. And as promised, here you can see the comparison. So each column represents an indices and each row is one of the different experiments. So the plain vanilla version at the very beginning is at the first row. The ideal world is a 2% inflation world. Then we have like the real inflation data. And for me, for example, as a Swiss investor, like the last row is the most important one, obviously. Quite noticeable and remarkable for me. I mean, when you see like the SMI is like 153 at the beginning, with 2% inflation, you drop down to 25, but the real inflation was even like less severe, and that's why you end up at 42.9, which is quite funny. As promised, and as a final bonus, here are the numbers including Bitcoin. I believe this is one of the key reasons Bitcoin has been so successful. For people living in countries with high levels of corruption, inflation, and other uncertainties, investing in Bitcoin and other hard assets is a no-brainer. But these are my personal thoughts. What do you guys think? Take care and all the best.